In 1997, George Lucas decided to improve the original Star Wars trilogy. He added new CGI creatures, tweaked the lighting, cleaned up the visuals, and of course changed who shot first. Technically these were upgrades, but to many fans it felt like Lucas had tinkered with something that was already perfect. And honestly, that's a pretty good way to think about XTOT. XTOT is BlackRock's newer Canadian-listed ETF that tracks the exact same index as XUU, the S&P Total Market Index. It doesn't change the story, the characters, or the ending. What it does change is how that exposure is delivered. So XTOT isn't really a sequel to XUU, it's the special edition. Same movie, a little more polish, and a few smoother edges. Whether that's an upgrade or just a remaster really depends on the investor. One of the main reasons people choose index investing is predictability. There's a certain comfort in knowing your ETF should move almost perfectly in line with its benchmark. And when it doesn't, even temporarily, it can feel unsettling, especially for more detail-oriented investors. That's where XUU occasionally rubs some people the wrong way. Now to be clear, over the long term, XUU did its job perfectly. From 2016 through 2024, it matched the S&P Total Market Index exactly after fees. But on a year-by-year basis, its tracking could look a bit uneven compared to its US counterpart, ITOT. Some years it slightly beat the index, other years it slightly lagged. Long-term investors didn't really care because those differences evened out over time. But indexing purists noticed. And the reason for that comes down to how XUU was built in the first place. When XUU launched back in February 2015, BlackRock wanted to give Canadian investors broad exposure to the entire US equity market. Large cap, mid cap, small cap, and even microcap stocks. But instead of buying thousands of individual US stocks directly, the managers took a more efficient route. They used existing US listed iShares ETFs whenever possible, leaning on BlackRock's scale to keep costs low. At the time though, there was a problem. BlackRock didn't yet offer a US ETF that directly tracked the S&P Total Market Index. ITOT was still tied to the S&P Composite 1500 Index, so XUU's managers had to get creative. They built a proxy for the total market by combining IVV for large caps, IJH for mid caps, IJR for small caps, and then filled in the remaining gaps with a basket of individual US stocks generated using BlackRock's Aladdin modeling system. It was clever, and it worked. And it delivered exactly what it promised. But by the end of 2015, things changed. ITOT switched to tracking the S&P Total Market Index directly, offering a much simpler way for XUU to get the same exposure. Even so, XUU's structure stayed the same. What started as a smart workaround eventually became a permanent design. Effective, but more complex than it needed to be. From 2016 through 2024, the S&P Total Market Index delivered an annualized return of 14.4% in Canadian dollars. Both ITOT and XUU matched that return exactly, even after fees. So performance was never the issue. I also find it helpful to look at their competitors' performance. Vanguard's VTI, which tracks the crisp US Total Market Index, delivered a nearly identical 14.42% annualized return in Canadian dollars. And its Canadian wrapper, VUN, which simply holds VTI, liked its index slightly more, largely due to its higher 0.17% MER. So all of this reinforced an important takeaway. There was nothing wrong with XUU's results. But when you compared XUU's multi-ETF plus stock structure to VUN's clean, one underlying ETF design, XUU started to look busy. So XUU wasn't broken, it just wasn't simple. And in the world of passive investing, simplicity sells. This is where XTOT enters the story. XTOT isn't a new strategy. It doesn't change the exposure, the index, or the fee. What it does change is the plumbing. Instead of stitching together multiple ETFs and individual stocks, XTOT simply holds ITOT directly. Same exposure as XUU, same management fees, with a cleaner design. For investors who are bothered by XUU's occasional short-term tracking noise, this structure offers something valuable: peace of mind. And for many investors, that's all they ever wanted. So, where does that leave investors today? If you're starting from scratch and looking for a Canadian-listed US equity ETF, XTOT is the obvious choice. It's simple, clean, and cost-effective right out of the gate. If you already own XUU in an RSP or TFSA, there's no urgency to switch. Over the long term, the two funds are functionally equivalent. But if the short-term tracking differences have always annoyed you, moving to XTOT is a reasonable cleanup. And if you hold VUN in a registered account, it may be worth waiting to see whether Vanguard responds by cutting VUN's 0.17% MER. If not, switching to XTOT would reduce your ongoing costs. And in taxable accounts, the math changes. If selling XUU or VUN would trigger a large capital gain, it's probably not worth it. In those cases, the better move is simply to use XTOT for new purchases going forward. XTOT isn't a revolution, it's refinement. BlackRock didn't reinvent US equity exposure for Canadians, they just cleaned up the packaging. For long-term investors, that might seem trivial. XUU already did its job beautifully. But in passive investing, perception matters. The smoother an ETF's tracking appears, the easier it is for investors to stay invested, and that behavioral edge can be just as important as a few basis points. XTOT is just the special edition of a classic. It's familiar, polished, and precise. Whether it's truly better or just prettier is up to each investor. But for those who value simplicity and consistency, this may finally be the version they've been waiting for. If you found this video helpful, feel free to give it a like, and if you want more straightforward ETF and portfolio content for Canadian investors, you can also subscribe so you don't miss any future videos. Thanks for watching. I'm Justin Bender, and I'll see you next time.